Part 2. The Origins of the Federal Reserve. The Progressive Movement. The Federal Reserve Act of December 23, 1913, was part and parcel of the wave of progressive legislation on local, state, and federal levels of government that began about 1900. Progressivism was a bipartisan movement which, in the course of the first 2 decades of the 20th century, transformed the American economy and society from one of roughly laissez-faire to one of centralized statism. Until the 1960s, historians had established the myth that progressivism was a virtual uprising of workers and farmers who, guided by a new generation of altruistic experts and intellectuals, surmounted fierce big business opposition in order to curb, regulate, and control what had been a system of accelerating monopoly in the late 19th century. A generation of research and scholarship, however, has now exploded that myth for all parts of the American polity, and it has become all too clear that the truth is the reverse of this well-worn fable. In contrast, what actually happened was that business became increasingly competitive during the late 19th century, and that various big business interests, led by the powerful financial house of J.P. Morgan and Company, had tried desperately to establish successful cartels on the free market. The first wave of such cartels was in the first large-scale business, railroads, and in every case, the attempt to increase profits by cutting sales with a quota system and thereby to raise prices or rates collapsed quickly from internal competition within the cartel and from external competition by new competitors eager to undercut the cartel. During the 1890s, in the new field of large-scale industrial corporations, big business interests tried to establish high prices and reduce production via mergers, and again, in every case, the mergers collapsed from the winds of the new competition. In both sets of cartel attempts, J.P. Morgan and Company had taken the lead, and in both sets of cases, the market, hampered though it was by high protective tariff walls, managed to nullify these attempts at voluntary cartelization. It then became clear to these big business interests that the only way to establish a cartelized economy, an economy that would ensure their continued economic dominance and high profits, would be to use the powers of government to establish and maintain cartels by coercion. In other words, to transform the economy from roughly laissez-faire to centralized and coordinated statism. But how could the American people, steeped in a long tradition of fierce opposition to government-imposed monopoly, go along with this program? How could the public's consent to the new order be engineered? Fortunately for the cartelists, a solution to this vexing problem lay at hand. Monopoly could be put over in the name of opposition to monopoly. In that way, using the rhetoric beloved by Americans, the form of the political economy could be maintained, while the content could be totally reversed. Monopoly had always been defined, in the popular parlance and among economists, as, quote, grants of exclusive privilege by the government. It was now simply redefined as, quote, big business, or business competitive practices, such as price cutting, so that regulatory commissions, from the Interstate Commerce Commission to the Federal Trade Commission to state insurance commissions, were lobbied for and staffed by big business men from the regulated industry, all done in the name of curbing, quote, big business monopoly on the free market. In that way, the regulatory commissions could subsidize, restrict, and cartelize in the name of, quote, opposing monopoly, as well as promoting the general welfare and national security. Once again, it was railroad monopoly that paved the way. For this intellectual shell game, the cartelists needed the support of the nation's intellectuals, the class of professional opinion molders in society. The Morgans needed a smokescreen of ideology, setting forth the rationale and the apologetics for the new order. Again, fortunately for them, the intellectuals were ready and eager for the new alliance. The enormous growth of intellectuals, academics, social scientists, technocrats, engineers, social workers, physicians, and occupational, quote, guilds of all types in the late 19th century led most of these groups to organize for a far greater share of the pie than they could possibly achieve on the free market. These intellectuals needed the state to license, restrict, and cartelize their occupations so as to raise the incomes for the fortunate people already in these fields. In return for their serving as apologists for the new statism, the state was prepared to offer not only cartelized occupations, but also ever-increasing and cushier jobs in the bureaucracy to plan and propagandize for the newly statized society. And the intellectuals were ready for it. Having learned in graduate schools in Germany the glories of statism and organicist socialism, of a harmonious, quote, middle way between dog-eat-dog laissez-faire on the one hand and proletarian Marxism on the other. Instead, big government, staffed by intellectuals and technocrats, steered by big business and aided by unions organizing a subservient labor force, would impose a cooperative commonwealth for the alleged benefit of all. Unhappiness with the national banking system. The previous big push for statism in America had occurred during the Civil War, when the virtual one-party Congress, after secession of the South, emboldened the Republicans to enact their cherished statist program under the cover of war. The alliance of big business and big government with the Republican Party drove through an income tax, heavy excise taxes on such sinful products as tobacco and alcohol, high protective tariffs, and huge land grants and other subsidies to transcontinental railroads. The overbuilding of railroads led directly to Morgan's failed attempts at railroad pools, and finally to the creation, promoted by Morgan and Morgan-controlled railroads, of the Interstate Commerce Commission in 1887. The result of that was the long, secular decline of the railroads, beginning before 1900. The income tax was annulled by Supreme Court action, but was reinstated during the Progressive period. The most interventionary of the Civil War actions was in the vital field of money and banking. The approach toward hard money and free banking that had been achieved during the 1840s and 1850s was swept away by two pernicious inflationary measures of the wartime Republican administration. One was fiat money greenbacks, which depreciated by half by the middle of the Civil War, and were finally replaced by the gold standard after urgent pressure by hard money Democrats, but not until 1879, some 14 full years after the end of the war. A second and more lasting intervention was the National Banking Acts of 1863, 1864, and 1865, which destroyed the issue of banknotes by state-chartered, or quote, state banks, by a prohibitory tax, and then monopolized the issue of banknotes in the hands of a few large, federally chartered, quote, national banks, mainly centered on Wall Street. In a typical cartelization, national banks were compelled by law to accept each other's notes and demand deposits at par, negating the process by which the free market had previously been discounting the notes and deposits of shaky and inflationary banks. In this way, the Wall Street federal government establishment was able to control the banking system and inflate the supply of notes and deposits in a coordinated manner. But there were still problems. The national banking system provided only a halfway house between free banking and government central banking, and by the end of the 19th century, the Wall Street banks were becoming increasingly unhappy with the status quo. The centralization was only limited, and, above all, there was no governmental central bank to coordinate inflation and to act as a lender of last resort, bailing out banks in trouble. No sooner had bank credit generated booms when they got into trouble, and bank-created booms turned into recessions, with banks forced to contract their loans and assets and to deflate in order to save themselves. Not only that, but after the initial shock of the National Banking Acts, state banks had grown rapidly by pyramiding their loans and demand deposits on top of national banknotes. These state banks, free of the high legal capital requirements that kept entry restricted in national banking, flourished during the 1880s and 1890s and provided stiff competition for the national banks themselves. Furthermore, St. Louis and Chicago, after the 1880s, provided increasingly severe competition to Wall Street. Thus, St. Louis and Chicago bank deposits, which had been only 16% of the St. Louis, Chicago, and New York City total in 1880, rose to 33% of that total by 1912. All in all, bank clearings outside of New York City, which were 24% of the national total in 1882, had risen to 43% by 1913. The complaints of the big banks were summed up in one word: inelasticity. The national banking system, they charged, did not provide for the proper elasticity of the money supply. That is, the banks were not able to expand money and credit as much as they wished, particularly in times of recession. In short, the national banking system did not provide sufficient room for inflationary expansions of credit by the nation's banks. By the turn of the century, the political economy of the United States was dominated by two generally clashing financial aggregations. The previously dominant Morgan Group, which had begun in investment banking and expanded into commercial banking, railroads, and mergers of manufacturing firms, and the Rockefeller forces, which began in oil refining and then moved into commercial banking, finally forming an alliance with the Kuhn-Loeb Company in investment banking and the Harriman interests in railroads. Although these two financial blocs usually clashed with each other, they were as one on the need for a central bank. Even though the eventual major role in forming and dominating the Federal Reserve System was taken by the Morgans, the Rockefeller and Kuhn-Loeb forces were equally enthusiastic in pushing and collaborating on what they all considered to be an essential monetary reform. The beginnings of the reform movement, the Indianapolis Monetary Convention. The presidential election of 1896 was a great national referendum on the gold standard. The Democratic Party had been captured at its 1896 convention by the populist, ultra-inflationist anti-gold forces headed by William Jennings Bryan. The older Democrats, who had been fiercely devoted to hard money and the gold standard, either stayed home on Election Day or voted, for the first time in their lives, for the hated Republicans. The Republicans had long been the party of prohibition and of greenback inflation and opposition to gold. But since the early 1890s, the Rockefeller forces, dominant in their home state of Ohio and nationally in the Republican Party, had decided to quietly ditch prohibition as a political embarrassment and as a grave deterrent to obtaining votes from the increasingly powerful bloc of German-American voters. In the summer of 1896, anticipating the defeat of the gold forces at the Democratic Convention, the Morgans, previously dominant in the Democratic Party, approached the McKinley, Mark Hanna, Rockefeller forces through their rising young satrap, Congressman Henry Cabot Lodge of Massachusetts. Lodge offered the Rockefeller forces a deal. The Morgans would support McKinley for president and neither sit home nor back a third, gold Democrat party, provided that McKinley pledged himself to a gold standard. The deal was struck, and many previously hard-money Democrats shifted to the Republicans. The nature of the American political party system was now drastically changed. Previously, a tightly fought struggle between hard money, free trade, laissez-faire Democrats on the one hand, and protectionist, inflationist, and statist Republicans on the other, with the Democrats slowly but surely gaining ascendancy by the early 1890s, was now a party system that would be dominated by the Republicans until the Depression election of 1932. The Morgans were strongly opposed to Bryanism, which was not only populist and inflationist, but also anti-Wall Street Bank. The Bryanites, much like populists of the present day, preferred congressional, greenback inflationism to the more subtle and more privileged big bank-controlled variety. The Morgans, in contrast, favored a gold standard, but once gold was secured by the McKinley victory in 1896, they wanted to press on to use the gold standard as a hard money camouflage, behind which they could change the system into one less nakedly inflationist than populism, but far more effectively controlled by the big banker elites. In the long run, a controlled Morgan-Rockefeller gold standard was far more pernicious to the cause of genuine hard money than a candid free silver or greenback Bryanism. As soon as McKinley was safely elected, the Morgan-Rockefeller forces began to organize a, quote, reform movement to cure the, quote, inelasticity of money in the existing gold standard, and to move slowly toward the establishment of a central bank. To do so, they decided to use the techniques they had successfully employed in establishing a pro-gold standard movement during 1895 and 1896. The crucial point was to avoid the public suspicion of Wall Street and banker control by acquiring the patina of a broad-based grassroots movement. To do so, the movement was deliberately focused in the Middle West, the heartland of America, and organizations developed that included not only bankers, but also businessmen, economists, and other academics who supplied respectability, persuasiveness, and technical expertise to the reform cause. Accordingly, the reform drive began just after the 1896 elections in authentic Midwest country. Hugh Henry Hanna, president of the Atlas Engine Works of Indianapolis, who had learned organizing tactics during the year with the pro-Gold Standard Union for Sound Money, sent a memorandum in November to the Indianapolis Board of Trade, urging a grassroots Midwestern state like Indiana to take the lead in currency reform. In response, the reformers moved fast. Answering the call of the Indianapolis Board of Trade, delegates from boards of trade from 12 Midwestern cities met in Indianapolis on December 1, 1896. The conference called for a large monetary convention of businessmen, which accordingly met in Indianapolis on January 12, 1897. Representatives from 26 states and the District of Columbia were present. The monetary reform movement was now officially underway. The influential Yale Review commended the convention for averting the danger of arousing popular hostility to bankers. It reported that, quote, the conference was a gathering of businessmen in general rather than bankers in particular, end quote. The conventioneers may have been businessmen, but they were certainly not very grassrootsy. Presiding at the Indianapolis Monetary Convention of 1897 was C. Stewart Patterson, Dean of the University of Pennsylvania Law School and a member of the Finance Committee of the powerful, Morgan-oriented Pennsylvania Railroad. The day after the convention opened, Hugh Hanna was named chairman of an executive committee which he would appoint. The committee was empowered to act for the convention after it adjourned. The executive committee consisted of the following influential corporate and financial leaders: John J. Mitchell of Chicago, president of the Illinois Trust and Savings Bank, and a director of the Chicago and Alton Railroad, the Pittsburgh, Fort Wayne, and Chicago Railroad, and the Pullman Company. Mitchell was named treasurer of the executive committee. H. H. Colsott, editor and publisher of the Chicago Times-Herald and the Chicago Ocean Herald, trustee of the Chicago Art Institute, and a friend and advisor of Rockefeller's main man in politics, President William McKinley. Charles Custis Harrison, provost of the University of Pennsylvania, who had made a fortune as a sugar refiner in partnership with the powerful Havemeyer, quote, Sugar Trust interests. Alexander E. Orr, New York City banker in the Morgan ambit, who was a director of the Morgan Run, Erie, and Chicago, Rock Island, and Pacific Railroads, of the National Bank of Commerce, and of the influential publishing house Harper Brothers. Orr was also a partner in the country's largest grain merchandising firm and a director of several life insurance companies. Edwin O. Stannard, St. Louis grain merchant, former governor of Missouri, and former vice president of the National Board of Trade and Transportation. E. B. Stallman, owner of the Nashville Banner, commissioner of the Cartelist Southern Railway and Steamship Association, and former vice president of the Louisville, New Albany, and Chicago Railroad. A. E. Wilson, influential attorney from Louisville and a future governor of Kentucky. But the two most interesting and powerful executive committee members of the Indianapolis Monetary Convention were Henry C. Payne and George Foster Peabody. Henry Payne was a Republican Party leader from Milwaukee and president of the Morgan-dominated Wisconsin Telephone Company, long associated with the railroad-oriented Spooner-Sawyer Republican machine in Wisconsin politics. Payne was also heavily involved in Milwaukee utility and banking interests, in particular as a longtime director of the North American Company, a large public utility holding company headed by New York City financier Charles W. Wetmore. So close was North American to the Morgan interests that its board included two top Morgan financiers. One was Edmund C. Converse, president of the Morgan-run Liberty National Bank of New York City, and soon to be founding president of Morgan's Bankers Trust Company. The other was Robert Bacon, a partner in J.P. Morgan and Company, and one of Theodore Roosevelt's closest friends, whom Roosevelt would make Assistant Secretary of State. Furthermore, when Theodore Roosevelt became president as the result of the assassination of William McKinley, he replaced Rockefeller's top political operative, Mark Hanna of Ohio, with Henry C. Payne as Postmaster General of the United States. Payne, a leading Morgan lieutenant, was reportedly appointed to what was then the major political post in the cabinet, specifically to break Hanna's hold over the National Republican Party. It seems clear that replacing Hanna with Payne was part of the savage assault that Theodore Roosevelt would soon launch against Standard Oil, as part of the open warfare about to break out between the Rockefeller, Harriman, Kuhn-Leb camp and the Morgan camp. Even more powerful in the Morgan ambit was the secretary of the Indianapolis Monetary Convention's Executive Committee, George Foster Peabody. The entire Peabody family of Boston Brahmins had long been personally and financially closely associated with the Morgans. A member of the Peabody clan had even served as best man at J.P. Morgan's wedding in 1865. George Peabody had long ago established an international banking firm of which J.P. Morgan's father, Junius, had been one of the senior partners. George Foster Peabody was an eminent New York investment banker with extensive holdings in Mexico, who was to help reorganize General Electric for the Morgans, and was later offered the job of Secretary of the Treasury during the Wilson administration. He would function throughout that administration as a, quote, statesman without portfolio. Let the masses be hoodwinked into regarding the Indianapolis Monetary Convention as a spontaneous, grassroots outpouring of small Midwestern businessmen. To the cognoscenti, any organization featuring Henry Payne, Alexander Orr, and especially George Foster Peabody meant but one thing: J.P. Morgan. The Indianapolis Monetary Convention quickly resolved to urge President McKinley to 1. Continue the gold standard, and 2. Create a new system of, quote, elastic bank credit. To that end, the convention urged the president to appoint a new monetary commission to prepare legislation for a new, revised monetary system. McKinley was very much in favor of the proposal, signaling Rockefeller agreement, and on July 24th, he sent a message to Congress urging the creation of a special monetary commission. The bill for a National Monetary Commission passed the House of Representatives, but died in the Senate. Disappointed but intrepid, the Executive Committee, failing a presidentially appointed commission, decided in August 1897 to go ahead and select its own. The leading role in appointing this commission was played by George Foster Peabody, who served as liaison between the Indianapolis members and the New York financial community. To select the commission members, Peabody arranged for the Executive Committee to meet in the Saratoga Springs summer home of his investment banking partner, Spencer Trask. By September, the Executive Committee had selected the members of the Indianapolis Monetary Commission. The members of the new Indianapolis Monetary Commission were as follows. Chairman was former Senator George F. Edmunds, Republican of Vermont, attorney, and former director of several railroads. C. Stuart Patterson, Dean of the University of Pennsylvania Law School, and a top official of the Morgan-controlled Pennsylvania Railroad. Charles S. Fairchild, a leading New York banker, president of the New York Security and Trust Company, former partner in the Boston Brahmin investment banking firm of Lee, Higginson and Company, and executive and director of 2 major railroads. Fairchild, a leader in New York state politics, had been Secretary of the Treasury in the first Cleveland administration. In addition, Fairchild's father, Sidney T. Fairchild, had been a leading attorney for the Morgan-controlled New York Central Railroad. Stuyvesant Fish, scion of 2 longtime aristocratic New York families, was a partner of the Morgan-dominated New York investment bank of Morton, Bliss and Company, and then president of Illinois Central Railroad and a trustee of Mutual Life. Fish's father had been a senator, governor, and secretary of state. Louis A. Garnett was a leading San Francisco businessman. Thomas G. Bush of Alabama was the director of the Mobile and Birmingham Railroad. J. W. Fries was a leading cotton manufacturer from North Carolina. William B. Dean was a merchant from St. Paul, Minnesota, and a director of the St. Paul-based Transcontinental Great Northern Railroad, owned by James J. Hill, ally with Morgan in the titanic struggle over the Northern Pacific Railroad with Harriman, Rockefeller, and Kuhn-Loeb. George Layton of St. Louis was an attorney for the Missouri Pacific Railroad. Robert S. Taylor was an Indiana patent attorney for the Morgan-controlled General Electric Company. The single most important working member of the commission was James Lawrence Laughlin, head professor of political economy at the new Rockefeller-founded University of Chicago and editor of its prestigious Journal of Political Economy. It was Laughlin who supervised the operations of the commission's staff and the writing of the reports. Indeed, the two staff assistants to the commission who wrote reports were both students of Laughlin's at Chicago, former student L. Carroll Roots and his current graduate student, Henry Parker Willis. The impressive sum of $50,000 was raised throughout the nation's banking and corporate community to finance the work of the Indianapolis Monetary Commission. New York City's large quota was raised by Morgan bankers Peabody and Orr, and heavy contributions to fill the quota came promptly from mining magnate William E. Dodge, cotton and coffee trader Henry Hentz, a director of the Mechanics National Bank, and J.P. Morgan himself. With the money in hand, the executive committee rented office space in Washington, D.C. in mid-September and set the staff to sending out and collating the replies to a detailed monetary questionnaire sent to several hundred selected experts. The Monetary Commission sat from late September into December 1897, sifting through the replies to the questionnaire collated by Roots and Willis. The purpose of the questionnaire was to mobilize a broad base of support for the Commission's recommendations, which they could claim represented hundreds of expert views. Second, the questionnaire served as an important public relations device, making the Commission and its work highly visible to the public, to the business community throughout the country, and to members of Congress. Furthermore, through this device, the Commission could be seen as speaking for the business community throughout the country. To this end, the original idea was to publish the Indianapolis Monetary Commission's preliminary report, adopted in mid-December, as well as the questionnaire replies in a companion volume. Plans for the questionnaire volume fell through, although it was later published as part of a series of publications on political economy and public law by the University of Pennsylvania. Undaunted by the slight setback, the executive committee developed new methods of molding public opinion using the questionnaire replies as an organizing tool. In November, Hugh Hanna hired as his Washington assistant financial journalist Charles A. Conant, whose task was to propagandize and organize public opinion for the recommendations of the Commission. The campaign to beat the drums for the forthcoming Commission report was launched when Conant published an article in the December 1st issue of Sound Currency magazine, taking an advanced line on the report and bolstering the conclusions not only with his own knowledge of monetary and banking history, but also with frequent statements from the as-yet unpublished replies to the staff questionnaire. Over the next several months, Conant worked closely with Jules Guthridge, the General Secretary of the Commission. They first induced newspapers throughout the country to print abstracts of the questionnaire replies. As Guthridge wrote some Commission members, he thereby stimulated, quote, public curiosity about the forthcoming report, and he boasted that by, quote, careful manipulation, he was able to get the preliminary report, quote, printed in whole or in parts, principally in parts, in nearly 7,500 newspapers, large and small, end quote. In the meanwhile, Guthridge and Conant orchestrated letters of support from prominent men across the country when the preliminary report was published on January 3, 1898. As soon as the report was published, Guthridge and Conant made these letters available to the daily newspapers. Quickly, the two built up a distribution system to spread the gospel of the report, organizing nearly 100,000 correspondents, quote, dedicated to the enactment of the Commission's plan for banking and currency reform, end quote. The prime and immediate emphasis of the preliminary report of the Indianapolis Monetary Commission was to complete the promise of the McKinley victory by codifying and enacting what was already in place de facto, a single gold standard with silver reduced to the status of subsidiary token currency. Completing the victory over Bryanism and free silver, however, was just a mopping-up operation. More important in the long run was the call raised by the report for banking reform to allow greater elasticity. Bank credit could then be increased in recessions, and whenever seasonal pressure for redemption by agricultural country banks forced the large central reserve banks to contract their loans. The actual measures called for by the Commission were of marginal importance. More important was that the question of banking reform had been raised at all. The public having been aroused by the preliminary report, the Executive Committee decided to organize a second and final meeting of the Indianapolis Monetary Convention, which duly met at Indianapolis on January 25, 1898. The second convention was a far grander affair than the first, bringing together 496 delegates from 31 states. Furthermore, the gathering was a cross-section of America's top corporate leaders. While the state of Indiana naturally had the largest delegation, of 85 representatives of boards of trade and chambers of commerce, New York sent 74 delegates, including many from the Board of Trade and Transportation, the Merchants Association, and the Chamber of Commerce in New York City. Such corporate leaders attended as Cleveland iron manufacturer Alfred A. Pope, president of the National Malleable Castings Company, Virgil P. Klein, legal counsel to Rockefeller's Standard Oil Company of Ohio, and C. A. Pillsbury of Minneapolis-St. Paul, organizer of the world's largest flour mills. From Chicago came such business notables as Marshall Field and Albert A. Sprague, a director of the Chicago Telephone Company, subsidiary of the Morgan-controlled telephone monopoly, American Telephone and Telegraph Company. Not to be overlooked was Delegate Franklin McVeigh, a wholesale grocer from Chicago and an uncle of a senior partner in the Wall Street law firm of Bangs, Stetson, Tracy, and McVeigh, counsel to J.P. Morgan and Company. McVeigh, who was later to become Secretary of the Treasury in the Taft administration, was wholly in the Morgan ambit. His father-in-law, Henry F. Eames, was the founder of the Commercial National Bank of Chicago, and his brother Wayne was soon to become a trustee of the Morgan-dominated Mutual Life Insurance Company. The purpose of the Second Convention, as former Secretary of the Treasury Charles S. Fairchild candidly explained in his address to the gathering, was to mobilize the nation's leading businessmen into a mighty and influential reform movement. As he put it, quote, "If men of business give serious attention and study to these subjects, they will substantially agree upon legislation, and thus agreeing, their influence will be prevailing." End quote. He concluded, quote, "My word to you is, pull all together." End quote. Presiding officer of the convention, Iowa Governor Leslie M. Shaw, was, however, a bit disingenuous when he told the gathering, quote, "You represent today not the banks, for there are few bankers on this floor. You represent the business industries and the financial interests of the country." End quote. There were plenty of bankers there, too. Shaw himself, later to be Secretary of the Treasury under Theodore Roosevelt, was a small-town banker in Iowa and president of the Bank of Denison, who continued as bank president throughout his term as convention governor. More important in Shaw's outlook and career was the fact that he was a longtime close friend and loyal supporter of the Des Moines Regency, the Iowa Republican machine headed by the powerful Senator William Boyd Allison. Allison, who was to obtain the Treasury post for his friend, was in turn tied closely to Charles E. Perkins, a close Morgan ally, president of the Chicago, Burlington, and Quincy Railroad, and kinsman of the powerful Forbes Financial Group of Boston, long tied in with the Morgan interests. Also serving as delegates to the Second Convention were several eminent economists, each of whom, however, came not as academic observers, but as representatives of elements of the business community. Professor Jeremiah W. Jenks of Cornell, a proponent of trust cartelization by government, and soon to become a friend and advisor of Theodore Roosevelt as governor, came as delegate from the Ithaca Business Men's Association. Frank W. Taussig of Harvard University represented the Cambridge Merchants Association. Yale's Arthur Twining Hadley, soon to be the president of Yale, represented the New Haven Chamber of Commerce, and Frank M. Taylor of the University of Michigan came as representative of the Ann Arbor Businessmen's Association. Each of these men held powerful posts in the organized economics profession, Jenkins, Taussig, and Taylor serving on the Currency Committee of the American Economic Association. Hadley, a leading railroad economist, also served on the boards of directors of Morgan's New York, New Haven, and Hartford and Atchison, Topeka, and Santa Fe railroads. Both Taussig and Taylor were monetary theorists who, while committed to a gold standard, urged reform that would make the money supply more elastic. Taussig called for an expansion of national banknotes, which would inflate in response to the, quote, needs of business. As Taussig put it, the currency would then, quote, grow without trammels as the needs of the community spontaneously call for increase, end quote. Taylor, too, as one historian puts it, wanted the gold standard to be modified by, quote, a conscious control of the movement of money, end quote, by government, quote, in order to maintain the stability of the credit system, end quote. Taylor justified governmental suspensions of specie payment to, quote, protect the gold reserve. On January 26, the convention delegates duly endorsed the preliminary report with virtual unanimity, after which Professor J. Lawrence Laughlin was assigned the task of drawing up a more elaborate final report, which was published and distributed a few months later. Laughlin's and the convention's final reports not only came out in favor of a broadened asset base for a greatly increased amount of national banknotes, but also called explicitly for a central bank that would enjoy a monopoly of the issue of banknotes. The convention delegates took the gospel of banking reform to the length and breadth of the corporate and financial communities. In April 1898, for example, A. Barton Hepburn, president of the Chase National Bank of New York, at that time a flagship commercial bank for the Morgan interests, and a man who would play a large role in the drive to establish a central bank, invited Indianapolis Monetary Commissioner Robert S. Taylor to address the New York State Bankers Association on the currency question, since, quote, bankers, like other people, need instruction upon this subject, end quote. All the monetary commissioners, especially Taylor, were active during the first half of 1898 in exhorting groups of businessmen throughout the nation for monetary reform. Meanwhile, in Washington, the lobbying team of Hanna and Conant was extremely active. A bill embodying the suggestions of the Monetary Commission was introduced by Indiana Congressman Jesse Overstreet in January and was reported out by the House Banking and Currency Committee in May. In the meantime, Conant met almost continuously with the Banking Committee members. At each stage of the legislative process, Hanna sent letters to the convention delegates and to the public, urging a letter-writing campaign in support of the bill. In this agitation, McKinley's Secretary of the Treasury, Lyman J. Gage, worked closely with Hanna and his staff. Gage sponsored similar bills, and several bills along the same lines were introduced in the House in 1898 and 1899. Gage, a friend of several of the monetary commissioners, was one of the top leaders of the Rockefeller interests in the banking field. His appointment as Treasury Secretary had been gained for him by Ohio's Mark Hanna, political mastermind and financial backer of President McKinley, and old friend, high school classmate, and business associate of John D. Rockefeller Sr. Before his appointment to the cabinet, Gage was president of the powerful First National Bank of Chicago, one of the major commercial banks in the Rockefeller ambit. During his term in office, Gage tried to operate the Treasury as a central bank, pumping in money during recessions by purchasing government bonds on the open market and depositing large funds with pet commercial banks. In 1900, Gage called vainly for the establishment of regional central banks. Finally, in his last annual report as Secretary of the Treasury in 1901, Lyman Gage let the cat completely out of the bag, calling outright for a government central bank. Without such a central bank, he declared in alarm, quote, individual banks stand isolated and apart, separated units with no tie of mutuality between them, end quote. Unless a central bank established such ties, Gage warned, the Panic of 1893 would be repeated. When he left office early the next year, Lyman Gage took up his post as president of the Rockefeller-controlled U.S. Trust Company in New York City. The Gold Standard Act of 1900 and after. Any reform legislation had to wait until after the elections of 1898, for the gold forces were not yet in control of Congress. In the autumn, the Executive Committee of the Indianapolis Monetary Convention mobilized its forces, calling on no less than 97,000 correspondents throughout the country through whom it had distributed the preliminary report. The Executive Committee urged its constituency to elect a gold standard Congress. When the gold forces routed the Silverites in November, the results of the election were hailed by Hanna as eminently satisfactory. The decks were now cleared for the McKinley administration to submit its bill, and the Congress that met in December 1899 quickly passed the measure. Congress then passed the conference report of the Gold Standard Act in March 1900. The currency reformers had gotten their way. It is well known that the Gold Standard Act provided for a single gold standard, with no retention of silver money except as tokens. Less well known are the clauses that began the march toward a more, quote, elastic currency. As Lyman Gage had suggested in 1897, national banks, previously confined to large cities, were now made possible with a small amount of capital in small towns and rural areas. And it was made far easier for national banks to issue notes. The object of these clauses, as one historian put it, was to satisfy a, quote, increased demand for money at crop moving time, and to meet popular cries for more money by encouraging the organization of national banks in comparatively undeveloped regions, end quote. The reformers exulted over the passage of the Gold Standard Act, but took the line that this was only the first step on the much-needed path to fundamental banking reform. Thus, Professor Frank W. Taussig of Harvard praised the act and greeted the emergence of a new social and ideological alignment caused by, quote, strong pressure from the business community, end quote, through the Indianapolis Monetary Convention. He particularly welcomed the fact that the Gold Standard Act, quote, treats the national banks not as grasping and dangerous corporations, but as useful institutions deserving the fostering care of the legislature, end quote. But such tender legislative care was not enough. Fundamental banking reform was needed, for, Taussig declared, quote, the changes in banking legislation are not such as to make possible any considerable expansion of the national system, or to enable it to render the community the full service of which it is capable, end quote. In short, the changes allowed for more and greater expansion of bank credits and the supply of money. Therefore, Taussig concluded, quote, it is well nigh certain that eventually Congress will have to consider once more the further remodeling of the national bank system, end quote. In fact, the Gold Standard Act of 1900 was only the opening gun of the banking reform movement. 3 friends and financial journalists, 2 from Chicago, were to play a large role in the development of that movement. Massachusetts-born Charles A. Conant, 1861 to 1915, a leading historian of banking, wrote A History of Modern Banks of Issue in 1896, while still a Washington correspondent for the New York Journal of Commerce and an editor of Banker's Magazine. After his stint of public relations work and lobbying for the Indianapolis Convention, Conant moved to New York in 1902 to become treasurer of the Morgan-oriented Morton Trust Company. The two Chicagoans, both friends of Lyman Gage, were, along with Gage, in the Rockefeller ambit. Frank A. Vanderlip was picked by Gage as his assistant secretary of the Treasury, and when Gage left office, Vanderlip came to New York as a top executive at the flagship commercial bank of the Rockefeller interests, the National City Bank of New York. Meanwhile, Vanderlip's close friend and mentor at the Chicago Tribune, Joseph French Johnson, had also moved east to become professor of finance at the Wharton School of the University of Pennsylvania. But no sooner had the Gold Standard Act been passed when Joseph Johnson sounded the trump by calling for more fundamental reform. Professor Johnson stated flatly that the existing banknote system was weak in not, quote, responding to the needs of the money market, end quote. That is, not supplying a sufficient amount of money. Since the national banking system was incapable of supplying those needs, Johnson opined, there was no reason to continue it. Johnson deplored the U.S. banking system as the worst in the world, and pointed to the glorious central banking system as existed in Britain and France. But no centralized banking system yet existed in the United States. Quote, in the United States, however, there is no single business institution, and no group of large institutions, in which self-interest, responsibility, and power naturally unite and conspire for the protection of the monetary system against twists and strains. End quote. In short, there was far too much freedom and decentralization in the system. In consequence, our massive deposit credit system, quote, trembles whenever the foundations are disturbed, end quote. That is, whenever the chickens of inflationary credit expansion come home to roost in demands for cash or gold. The result of the inelasticity of money and of the impossibility of interbank cooperation, Johnson opined, was that we were in danger of losing gold abroad just at the time when gold was needed to sustain confidence in the nation's banking system. After 1900, the banking community was split on the question of reform. The small and rural bankers preferring the status quo, but the large bankers, headed by A. Barton Hepburn of Morgan's Chase National Bank, drew up a bill as head of a commission of the American Bankers Association and presented it in late 1901 to Representative Charles N. Fowler of New Jersey, chairman of the House Banking and Currency Committee, who had introduced one of the bills that had led to the Gold Standard Act. The Hepburn proposal was reported out of committee in April 1902 as the Fowler Bill. The Fowler Bill contained three basic clauses. One allowed the further expansion of national banknotes based on broader assets than government bonds. The second, a favorite of the big banks, was to allow national banks to establish branches at home and abroad, a step illegal under the existing system due to fierce opposition by the small country bankers. While branch banking is consonant with a free market and provides a sound and efficient system for calling on other banks for redemption, the big banks had little interest in branch banking unless accompanied by centralization of the banking system. Thus, the Fowler Bill proposed to create a three-member board of control within the Treasury Department to supervise the creation of the new bank notes and to establish clearinghouse associations under its aegis. This provision was designed to be the first step toward the establishment of a full-fledged central bank. Although they could not control the American Bankers Association, the multitude of country bankers, up in arms against the proposed competition of big banks in the form of branch banking, put fierce pressure upon Congress and managed to kill the Fowler Bill in the House during 1902. Despite the agitation of the Executive Committee and staff of the Indianapolis Monetary Convention. With the defeat of the Fowler Bill, the big bankers decided to settle for more modest goals for the time being. Senator Nelson W. Aldrich of Rhode Island, perennial Republican leader of the U.S. Senate and Rockefeller's man in Congress, submitted the Aldrich Bill the following year, allowing the large national banks in New York to issue, quote, emergency currency based on municipal and railroad bonds. But even this bill was defeated. Meeting setbacks in Congress, the big bankers decided to regroup and turn temporarily to the executive branch. Foreshadowing a later, more elaborate collaboration, two powerful representatives, each from the Morgan and Rockefeller banking interests, met with the Comptroller of the Currency, William B. Ridgely, in January 1903 to try to persuade him, by administrative fiat, to restrict the volume of loans made by the country banks in the New York money market. The two Morgan men at the meeting were J.P. Morgan and George F. Baker, Morgan's closest friend and associate in the banking business. The two Rockefeller men were Frank Vanderlip and James Stillman, longtime chairman of the board of the National City Bank. The close Rockefeller-Stillman alliance was cemented by the marriage of the two daughters of Stillman to the two sons of William Rockefeller, brother of John D. Rockefeller Sr., and longtime board member of the National City Bank. The meeting with the comptroller did not bear fruit, but the lead instead was taken by the Secretary of the Treasury himself, Leslie Shaw, formerly presiding officer at the Second Indianapolis Monetary Convention, whom President Roosevelt appointed to replace Lyman Gage. The unexpected and sudden shift from McKinley to Roosevelt in the presidency meant more than just a turnover of personnel. It meant a fundamental shift from a Rockefeller-dominated to a Morgan-dominated administration. In the same way, the shift from Gage to Shaw was one of the many Rockefeller to Morgan displacements. On monetary and banking matters, however, the Rockefeller and Morgan camps were as one. Secretary Shaw attempted to continue and expand Gage's experiments in trying to make the Treasury function like a central bank, particularly in making open market purchases in recessions and in using Treasury deposits to bolster the banks and expand the money supply. Shaw violated the statutory institution of the independent Treasury, which had tried to confine government revenues and expenditures to its own coffers. Instead, he expanded the practice of depositing Treasury funds in favored big national banks. Indeed, even banking reformers denounced the deposit of Treasury funds to pet banks as artificially lowering interest rates and leading to artificial expansion of credit. Furthermore, any government deficit would obviously throw a system dependent on a flow of new government revenues into chaos. All in all, the reformers agreed increasingly with the verdict of economist Alexander Porves that, quote, "The uncertainty as to the Secretary's power to control the banks by arbitrary decisions and orders, and the fact that at some future time the country may be unfortunate in its chief Treasury official, has led many to doubt the wisdom," end quote, of using the Treasury as a form of central bank. In his last annual report of 1906, Secretary Shaw urged that he be given total power to regulate all the nation's banks. But the game was up, and by then it was clear to the reformers that Shaw's, as well as Gage's, proto-central bank manipulations had failed. It was time to undertake a struggle for a fundamental, legislative overhaul of the American banking system, to bring it under central banking control. Charles A. Conant, Surplus Capital, and Economic Imperialism. The years shortly before and after 1900 proved to be the beginnings of the drive toward the establishment of a Federal Reserve System. It was also the origin of the gold exchange standard, the fateful system imposed upon the world by the British in the 1920s and by the United States after World War II at Bretton Woods. Even more than the case of a gold standard with a central bank, the gold exchange standard establishes a system, in the name of gold, which in reality manages to install coordinated, international, inflationary paper money. The idea was to replace a genuine gold standard, in which each country, or domestically each bank, maintains its reserves in gold, by a pseudo-gold standard in which the central bank of the client country maintains its reserves in some key or base currency, say pounds or dollars. Thus, during the 1920s, most countries maintained their reserves in pounds, and only Britain purported to redeem pounds in gold. This meant that these other countries were really on a pound rather than a gold standard, although they were able, at least temporarily, to acquire the prestige of gold. It also meant that when Britain inflated pounds, there was no danger of losing gold to these other countries, who, quite the contrary, happily inflated their own currencies on top of their expanding balances in pound sterling. Thus, there was generated an unstable, inflationary system, all in the name of gold, in which client states pyramided their own inflation on top of Great Britain's. The system was eventually bound to collapse, as did the gold exchange standard in the Great Depression and Bretton Woods by the late 1960s. In addition, the close ties based on pounds and then dollars meant that the key or base currency was able to exert a form of economic imperialism, joined by its common paper and pseudo-gold inflation, upon the client states using the key money. By the late 1890s, groups of theoreticians in the United States were working on what would later be called the, quote, Leninist theory of capitalist imperialism. The theory was originated not by Lenin, but by advocates of imperialism, centering around such Morgan-oriented friends and brain trusters of Theodore Roosevelt as Henry Adams, Brooks Adams, Admiral Alfred T. Mahan, and Massachusetts Senator Henry Cabot Lodge. The idea was that capitalism in the developed countries was, quote, overproducing, not simply in the sense that more purchasing power was needed in recessions, but more deeply in that the rate of profit was therefore inevitably falling. The ever lower rate of profit from the, quote, surplus capital was in danger of crippling capitalism, except that salvation loomed in the form of foreign markets and especially foreign investments. New and expanded foreign markets would increase profits, at least temporarily, while investments in undeveloped countries would be bound to bring a high rate of profit. Hence, to save advanced capitalism, it was necessary for Western governments to engage in outright imperialist or neo-imperialist ventures, which would force other countries to open their markets for American products and would force open investment opportunities abroad. Given this doctrine, based on the fallacious Ricardian view that the rate of profits is determined by the stock of capital investment, instead of by the time preferences of everyone in society, there was little for Lenin to change except to give an implicit moral condemnation instead of approval, and to emphasize the necessarily temporary nature of the respite imperialism could furnish for capitalists. Charles Conant set forth the theory of surplus capital in his A History of Modern Banks of Issue, and developed it in subsequent essays. The existence of fixed capital and modern technology, Conant claimed, invalidated Say's law and the concept of equilibrium, and led to chronic, quote, over-savings, which he defined as savings in excess of profitable investment outlets in the developed Western capitalist world. Business cycles, opined Conant, were inherent in the unregulated activity of modern industrial capitalism. Hence, the importance of government-encouraged monopolies and cartels to stabilize markets and the business cycle, and in particular the necessity of economic imperialism to force open, profitable outlets abroad for American and other Western surplus capital. The United States' bold venture into an imperialist war against Spain in 1898 galvanized the energies of Conant and other theoreticians of imperialism. Conant responded with his call for imperialism in The Economic Basis of Imperialism in the September 1898 North American Review, and in other essays collected in the United States in the Orient, The Nature of the Economic Problem, and published in 1900. S. J. Chapman, a distinguished British economist, accurately summarized Conant's argument as follows. 1. Quote, in all advanced countries, there has been such excessive saving that no profitable investment for capital remains. End quote. 2. Since all countries do not practice a policy of commercial freedom, quote, America must be prepared to use force if necessary, end quote, to open up profitable investment outlets abroad. And 3. The United States possesses an advantage in the coming struggle, since the organization of many of its industries, quote, in the form of trusts, will assist it greatly in the fight for commercial supremacy. End quote. The war successfully won. Conant was particularly enthusiastic about the United States keeping the Philippines, the gateway to the great potential Asian market. The United States, he opined, should not be held back by, quote, an abstract theory to adopt, quote, extreme conclusions on applying the doctrines of the Founding Fathers on the importance of the consent of the governed. The Founding Fathers, he declared, surely meant that self-government could only apply to those competent to exercise it, a requirement that clearly did not apply to the backward people of the Philippines. After all, Conant wrote, quote, only by the firm hand of the responsible governing races can the assurance of uninterrupted progress be conveyed to the tropical and undeveloped countries. End quote. Conant also was bold enough to derive important domestic conclusions from his enthusiasm for imperialism. Domestic society, he claimed, would have to be transformed to make the nation as, quote, efficient as possible. Efficiency, in particular, meant centralized concentration of power. Quote, concentration of power, in order to permit prompt and efficient action, will be an almost essential factor in the struggle for world empire. End quote. In particular, it was important for the United States to learn from the magnificent centralization of power and purpose in Tsarist Russia. The government of the United States would require, quote, a degree of harmony and symmetry which will permit the direction of the whole power of the state toward definite and intelligent policies. End quote. The U.S. Constitution would have to be amended to permit a form of Tsarist absolutism, or at the very least, an enormously expanded executive power in foreign affairs. An interesting case study of business opinion, energized and converted by the lure of imperialism, was the Boston Weekly, The U.S. Investor. Before the outbreak of the war with Spain in 1898, the U.S. Investor denounced the idea of war as a disaster to business. But after the United States launched its war, and Commodore Dewey seized Manila Bay, the Investor totally changed its tune. Now it hailed the war as excellent for business, and as bringing about recovery from the previous recession. Soon, the Investor was happily advocating a policy of, quote, imperialism, to make the U.S. prosperity permanent. Imperialism conveyed marvelous benefits to the country. At home, a big army and navy would be valuable in curbing the tendency of democracy to enjoy, quote, a too great freedom from restraint, both of action and of thought, end quote. The Investor added that, quote, European experience demonstrates that the Army and Navy are admirably adapted to inculcate orderly habits of thought and action. End quote. But an even more important benefit from a policy of permanent imperialism is economic. To keep, quote, capital at work, stern necessity requires that, quote, an enlarged field for its product must be discovered, end quote. Specifically, quote, a new field had to be found for selling the growing flood of goods produced by the advanced nations, and for investment of their savings at profitable rates. The Investor exulted in the fact that this new, quote, field lies ready for occupancy. It is to be found among the semi-civilized and barbarian races, end quote, in particular, the beckoning country of China. Particularly interesting was the colloquy that ensued between the Investor and the Springfield, Massachusetts Republican, which still propounded the older theory of free trade and laissez-faire. The Republican asked why free trade with undeveloped countries was not sufficient without burdening U.S. taxpayers with administrative and military overhead. The Republican also attacked the new theory of surplus capital, pointing out that only 2 or 3 years earlier, businessmen had been loudly calling for more European capital to be invested in American ventures. To the first charge, the Investor fell back on, quote, the experience of the race for perhaps 90 centuries, which has been in the direction of foreign acquisitions as a means of national prosperity, end quote. But, more practically, the investor delighted over the goodies that imperialism would bring to American business in the way of government contracts and the government development that would now be called the, quote, infrastructure of the colonies. Furthermore, as in Britain, a greatly expanded diplomatic service would provide, quote, a new calling for our young men of education and ability, end quote. To the Republicans' second charge on surplus capital, the investor, like Conant, developed the idea of a new age that had just arrived in American affairs, an age of large scale and hence overproduction, an age of a low rate of profits, and consequent formation of trusts in a quest for higher profits through suppression of competition. As the investor put it, quote, the excess of capital has resulted in an unprofitable competition. To employ Franklin's witticism, the owners of capital are of the opinion they must hang together or else they will all hang separately, end quote. But while trust may solve the problem of specific industries, they did not solve the great problem of a general, quote, congestion of capital. Indeed, wrote the investor, quote, finding employment for capital is now the greatest of all economic problems that confront us, end quote. To the investor, the way out was clear. Quote, the logical path to be pursued is that of the development of the natural riches of the tropical countries. These countries are now peopled by races incapable of their own initiative of extracting its full riches from their own soil. This will be attained in some cases by the mere stimulus of governments and direction by men of the temperate zones. But it will be attained also by the application of modern machinery and methods of culture to the agricultural and mineral resources of the undeveloped countries. End quote. By the spring of 1901, even the eminent economic theorist John Bates Clark of Columbia University was able to embrace the new creed. Reviewing the pro-imperialist works by Conant, Brooks Adams, and the Reverend Josiah Strong in a single celebratory review in March 1901 in the Political Science Quarterly, Clark emphasized the importance of opening foreign markets and particularly of investing American capital, quote, with an even larger and more permanent profit, end quote. J.B. Clark was not the only economist ready to join in apologia for the strong state. Throughout the land by the turn of the 20th century, a legion of economists and other social scientists had arisen, many of them trained in graduate schools in Germany to learn the virtues of the inductive method, the German historical school, and a collectivist, organicist state. Eager for positions and power commensurate with their graduate training, these new social scientists, in the name of professionalism and technical expertise, prepared to abandon the old laissez-faire creed and take their places as apologists and planners in a new, centrally planned state. Professor Edwin R.A. Seligman of Columbia University, of the prominent Wall Street investment banking family of J. and W. Seligman and Company, spoke for many of these social scientists when, in a presidential address before the American Economic Association in 1903, he hailed the, quote, new industrial order. Seligman prophesied that in the new 20th century, the possession of economic knowledge would grant economists the power, quote, to control and mold, end quote, the material forces of progress. As the economist proved able to forecast more accurately, he would be installed as, quote, the real philosopher of social life, end quote, and the public would pay, quote, deference to his views. In his 1899 presidential address, Yale President Arthur Twining Hadley also saw economists developing as society's philosopher kings. The most important application of economic knowledge, declared Hadley, was leadership in public life, becoming advisors and leaders of national policy. Hadley opined, quote, I believe that there, economists, largest opportunity in the immediate future lies not in theories but in practice, not with students but with statesmen, not in the education of individual citizens, however widespread and salutary, but in the leadership of an organized body politic, end quote. Hadley perceptively saw the executive branch of the government as particularly amenable to access of position and influence to economic advisors and planners. Previously, executives were hampered in seeking such expert counsel by the importance of political parties, their ideological commitments, and their mass base in the voting population. But now, fortunately, the growing municipal reform, soon to be called the progressive movement, was taking power away from political parties and putting it into the hands of administrators and experts. The, quote, increased centralization of administrative power was giving the expert a fair chance, end quote. And now, on the national scene, the new American leap into imperialism in the Spanish-American War was providing an opportunity for increased centralization, executive power, and therefore for administrative and expert planning. Even though Hadley declared himself personally opposed to imperialism, he urged economists to leap at this great opportunity for access to power. The organized economic profession was not slow to grasp this new opportunity. Quickly, the executive and nominating committees of the American Economic Association, or AEA, created a 5-man special committee to organize and publish a volume on colonial finance. As Silva and Slaughter put it, this new, rapidly put-together volume permitted the AEA to show the power elite, quote, how the new social science could serve the interests of those who made imperialism a national policy by offering technical solutions to the immediate fiscal problems of colonies, as well as providing ideological justifications for acquiring them, end quote. Chairman of the special committee was Professor Jeremiah W. Jenks of Cornell, the major economic advisor to New York Governor Theodore Roosevelt. Another member was Professor E.R.A. Seligman, another key advisor to Roosevelt. A third colleague was Dr. Albert Shaw, influential editor of the Review of Reviews, progressive reformer and social scientist, and longtime crony of Roosevelt's. All three were longtime leaders of the American Economic Association. The other two non-AEA leaders on the committee were Edward R. Strobel, former Assistant Secretary of State and advisor to colonial governments, and Charles S. Hamlin, wealthy Boston lawyer and Assistant Secretary of the Treasury who had long been in the Morgan ambit, and whose wife was a member of the Pruitt family, longtime investors in 2 Morgan-dominated concerns, the New York Central Railroad and the Mutual Life Insurance Company of New York. Essays in Colonial Finance, the volume quickly put together by these 5 leaders, tried to advise the United States how best to run its newly acquired empire. First, just as the British government insisted when the North American states were its colonies, the colonies should support their imperial government through taxation, whereas control should be tightly exercised by the United States Imperial Center. Second, the Imperial Center should build and maintain the economic infrastructure of the colony, canals, railroads, communications. Third, where, as was clearly anticipated, native labor is inefficient or incapable of management, the imperial government should import white labor from the imperial center. And finally, as Silva and Slaughter put it, quote, the committee's fiscal recommendations strongly intimated that trained economists were necessary for a successful empire. It was they who must make a thorough study of local conditions to determine the correct fiscal system, gather data, create the appropriate administrative design, and perhaps even implement it. In this way, the committee seconded Hadley's views in seeing as an opportunity for economists by identifying a large number of professional positions best filled by themselves. End quote. With the volume written, the AEA cast about for financial support for its publication and distribution. The point was not simply to obtain the financing, but to do so in such a way as to gain the imprimatur of leading members of the power elite on this bold move for power to economists as technocratic expert advisors and administrators in the imperial nation-state. The American Economic Association found 5 wealthy businessmen to put up $125, 2/5 of the full cost of publishing essays in colonial finance. By compiling the volume and then accepting corporate sponsors, several of whom had an economic stake in the new American empire, the AEA was signaling that the nation's organized economists were 1. Wholeheartedly in favor of the new American empire, and 2. Willing and eager to play a strong role in advising and administering the empire, a role which they promptly and happily filled, as we shall see in the following section. In view of the symbolic as well as practical role for the sponsors, a list of the 5 donors for the colonial finance volume is instructive. One was Isaac N. Seligman, head of the investment banking house of J&W Seligman and Company, a company with extensive overseas interests, especially in Latin America. Isaac's brother, E.R.A. Seligman, was a member of the Special Committee on Colonial Finance and an author of one of the essays in the volume. Another was William E. Dodge, a partner of the copper mining firm of Phelps, Dodge and Company, and member of a powerful mining family allied to the Morgans. A third donor was Theodore Marburg, an economist who was vice president of the AEA at the time, and also an ardent advocate of imperialism as well as heir to a substantial American tobacco company fortune. Fourth was Thomas Shearman, a single taxer and an attorney for powerful railroad magnate Jay Gould. And last but not least, Stuart Wood, a manufacturer who had a PhD in economics and had been a vice president of the AEA.